Hey everyone, and welcome to this explainer. Today, we're going to absolutely demystify a process that will honestly completely change how you look at a trading chart. Look, if you're a trader, finding your bias, knowing exactly where the price is actually going to move next is basically the holy grail. It's the one thing that separates the consistently profitable folks from those who are, well, just guessing out there. So today we're going to break down this really complex process of finding that bias, and we're going to do it using smart money concepts. Okay, let's just dive right into this and turn what feels like a total guessing game into a highly structured, totally repeatable process.
Here's our roadmap for today's explainer. 1. The endless trading game. 2. Identifying key levels. 3. The three-candle swing. 4. Top-down time frame analysis. And 5. Executing the trade.
Start with Section 1, the endless trading game.
Man, it's a super frustrating reality for a lot of us, right? Why do your stop losses just keep getting hit while you're desperately out there trying to find the market trend? You do the analysis, you draw all your lines, and yet it's like the market is literally hunting your position. Well, the answer comes down to a fundamental misunderstanding of market mechanics. Traders constantly hit their stop losses because they totally misunderstand this active, really magnetic relationship between where the price currently is and where it's actually being pulled.
Think of it like this. The market behaves exactly like a giant game of cops and robbers, or chore police. It's this endless, non-stop loop between a point of interest, or a POI, and liquidity. If the price is sitting at a point of interest, it instantly becomes the cop, actively hunting down the robbers, and in this case, the robbers are the liquidity. The algorithm doesn't just wander around randomly, it specifically seeks out these pools of orders. And here's the kicker. Once it grabs that liquidity, the whole game resets, and price immediately spins around to seek out the next point of interest. This loop, it literally never stops. And if you aren't tracking it, well, you're going to be the one getting caught.
Another way to look at it is like a massive football game. The price is the ball. Just like players passing a ball around with different amounts of force, price gets powerfully pushed from one key level to another across the chart. Now, some levels are kind of like exhausted players, right? They just kick the price super softly, giving you a really weak move. But other levels, they have real institutional strength to boot that ball massive distances across the field, totally flipping the momentum. Your only job is to find those really strong players.
Which brings us to Section 2, identifying key levels.
So while there are a ton of points of interest out there, mitigation blocks, breaker blocks, all that stuff, you absolutely have to follow a strict hierarchy. Order blocks. They hold the highest priority, hands down. They are your strongest players because they represent areas of massive institutional buying or selling. Right below that, you have imbalances, and then finally, fair value gaps, or FGVs. When you're scanning a chart, you've got to prioritize finding these specific levels because they have the highest probability of actually holding the line and forcefully pushing that price. But where exactly are they kicking the price to? Well, that brings us to liquidity. Liquidity is the ultimate destination. These are just key areas where resting orders, things like retail stop losses or pending breakout entries, are piled up in massive quantities. After price violently shoots away from a POI, it is magnetically drawn toward these pools of liquidity to fuel its very next move. Smart money actually needs these pools so they can exit their own giant positions.
Now you've got to be able to spot the different flavors of liquidity. First up is low resistance liquidity. This is where price moves smoothly without building up any opposing blocks, making it just an incredibly easy target for the market to slice right through. Then you've got high resistance liquidity, where the price moves super choppily enough to bunch of structural hurdles in the way. Also, make sure you mark the monthly, weekly, and daily highs and lows right alongside your obvious swing highs and lows. Why? Because these are the absolute prime targets the market wants to hunt. They're basically the largest pockets of trapped traders.
Let's move on to Section 3, the three-candle swing. I absolutely love this analogy because it hits the nail right on the head regarding what trips up so many eager traders. Listen, you cannot blindly trust any key level. Price doesn't just reverse instantly on a dime. It takes a U-turn, exactly like a car. Think about it. If you're flying down the highway and need to go the exact opposite direction, you can't just slam the car into reverse. No way. You have to slow down, turn the wheel, and then accelerate. Price does the exact same thing. It has to perform a calculated multi-step U-turn pattern to actually confirm a true reversal at a point of interest.
So, you've got to patiently wait for these exact 4 steps to play out. Step 1, the first candle taps right into the POI zone. That's our initial slowdown. Step 2, the second candle creates a strong displacement. That's a powerful, really aggressive move away that proves the level has genuine institutional muscle behind it.
Step 3, the third candle pulls back for a retest to fill the lower timeframe POIs that the displacement candle left behind. And finally, Step 4, expansion. This is the aggressive move straight towards your targeted liquidity. If you don't see this exact pattern, the POI is not confirmed, and you absolutely should not be entering that trade.
All right, Section 4, Top-Down Timeframe Analysis.
So to build an unbreakable bias, we have to strictly analyze the chart in this exact flow. You start way out on the 1-month chart to find the massive overarching direction. Then you step down to the 1-week chart to refine those zones. Next, you use the 1-day chart to confirm the immediate structural shifts. And finally, you drop all the way down to the 1-hour chart for your precise execution. If you skip a step in this funnel, well, that's exactly how you get trapped on the wrong side of the market.
Let's start at the very top, the monthly chart. Honestly, you only really need to look at this maybe once or twice a month. Your goal here is super simple but incredibly crucial. Mark your nearest key levels. Find your overarching POIs and liquidity pools. This is going to determine your macro direction for the next 2 to 3 months. Remember that game of cops and robbers? Price acts like a cop chasing the closest robber first. Find the closest major liquidity pool on this monthly time frame, and bam, that becomes your ultimate unavoidable magnet.
Now, as we zoom into the weekly and daily charts, your job shifts to refining things. Immediately disregard any POIs that just got blown right through without a proper displacement and retest. I seriously cannot stress this enough. They are totally useless now. Do not try to trade them. Here, you're actively hunting for market structure shifts and just waiting patiently for that 3-candle swing confirmation at your major levels. That's what validates your macro bias and actually tells you, hey, the big players are finally stepping in.
And now for the final piece of the puzzle. Section 5, Executing the Trade.
The 1-hour time frame. This, or maybe even a lower time frame depending on your personal style, is solely where you pull the trigger. But listen to me closely on this. You should absolutely never use the 1-hour chart to dictate your overarching bias. Never. It is strictly a tool for entering a trade that has already been meticulously decided by the monthly, weekly, and daily charts. If you let the 1-hour dictate your bias, you're just reacting to noise instead of following the true trend. Okay, this execution phase, it requires insane discipline. You must only take trades that align perfectly with the higher time frame liquidity draw. Like, if your monthly bias is pointing up towards a major liquidity pool, you have to aggressively ignore all bearish order blocks on those lower time frames. Let me say that again. Do not try to short them. You should literally only be hunting for buying setups that ride the larger wave towards your higher time frame target. Fighting the higher time frame is just a guaranteed way to lose your capital.
So, here is your strict execution checklist. First, confirm your daily bias perfectly aligns with your macro view. Next, wait for a lower time frame market structure shift to really show intent. Then, and this is a huge safety check, only enter on the retest of the displacement candle's final POI. Please don't chase the initial breakout. Wait for the price to come back to you. And finally, set your target for the nearest higher time frame liquidity. Following this exact checklist, make sure you capture that massive expansion phase safely and with a nice tight stop loss.
But hey, what happens if you just get completely lost? If the price action ever feels super confusing and you honestly don't know where you are in the cycle, just pull a dealing range tool over the current leg, from the swing low all the way to the swing high. You want to pinpoint the 0.6 and 0.7 discount levels. Consider these specific levels your ultimate safety net. They align perfectly with structural bias and give you an incredibly high probability zone to find your entry points when the chart just starts looking like total chaos. So, by mastering this continuous POI to liquidity loop and by strictly following the top-down funnel we just went over, your chart reading is going to completely transform. You aren't going to be guessing anymore. You're going to be tracking the market's true footprint. But look, the real question you've got to ask yourself right now is this. Do you actually have the discipline to sit on your hands and wait for the 3-candle swing before pulling the trigger? Master that patience, and you master the market. Thanks so much for joining me on this explainer, and happy trading.